Thanks, Rob, for being with us. I'll ask the million-dollar question that's on everyone's mind. Out of all the names that are out there, how does one end up with Kabbage?
I end up with Kabbage. It's funny, when we first came up with the name for Kabbage, I actually didn't even really like the name. I was uncomfortable with it. But I knew at the moment that we came up with it, and it was derived after many evenings with my co-founders, trying to go through every possible machination of name, every possible variation of name. So we went with various food themes, vegetable themes, other types of like streams and currents and things like that. And finally happened upon food, and one of my co-founders said, how about Kabbage? And Kabbage is actually a colloquialism for cash from the early 1900s, used in the US, but also used in different parts of the world. And Kabbage with the C was, Kabbage with a C was going to cost, .com was going to cost $75,000. Kabbage with a K was $1,200. We had absolutely no money, so we went with the $1,200. And I knew it was a name, even though I was uncomfortable with it, I knew it was a name that you'd either love it or you'd hate it, but you wouldn't forget it. And so the nice thing about it is it's very different than any other name out there, and it's something that's really stuck with a lot of people.
Yeah, absolutely. I think it's tough. It's a tough one to forget. Now that we have that out of the way, I want to ask you, so you're not a financial services guy. How do you stumble upon starting up a fintech that is focused on SMEs? Yeah? And what do you do differently from the banks?
Sure. So, I think, so I wasn't in financial services. I had some interaction in financial services in one of my prior lives and a couple of my prior lives, but I definitely wasn't a financial services guy. I would argue that I am now, just by the nature of being in it every day and every minute and every second. How we differentiate is I really, and my co-founder Catherine is in the audience as well, we really came at it from a different angle. I think a lot of people who got into what is now termed alternative lending or specialty finance, their whole concept was, how can I fill the void left by banks? There's this huge void of small businesses that are not getting capital. How can I fill that void? We actually came at it from a completely different angle. I had been working with a company that was pulling down data from online marketplaces. So think about places like eBay and Amazon, and we were pulling down that data to identify counterfeit and fraudulent products sold online. And it was very robust real-time data, and I basically just said to myself, and I talk to myself a lot, what if you use that data for something other than what I had been used to using data for, which was determining whether to buy a product? What if we used it for determining the credit worthiness of a small business that's selling over one of these marketplaces? Could you do that? And so we came at it from a very data technology oriented focus rather than from can I fill the void focus. And I think that orientation is the thing that's really helped us over the last several years, especially over the last year and a half, where times have gotten a little bit more difficult for a lot of our brethren in the space, and where we've really been able to separate, I think, a lot from the pack.
So how does Kabbage do lending differently? You talked about data. Is data the secret weapon? And one of the big challenges in banking, and we just went through a 2-year cycle where the SME market struggle a lot, especially the banks that give debt to the SME market. How do you go about making sure you somehow manage to weather the storms of defaults and provisions?
Yeah, and it's a great question. And I do call data the secret weapon, but probably not for the reason that most people think. Of course, the initial thought on the idea was utilizing data as a better indicator of risk and figuring out whether a particular small business was credit worthy. But there's really two aspects to what we do that are very different than anybody else. Yes, we use a wide range of what's called alternative data, and frankly, I get a little tired of the term alternative data, because anything that is not specifically used by banks in its underwriting process today is naturally alternative. And so everything under the sun is alternative. I'd say the real key component, and it drives more than just underwriting, which I'll talk to in a moment, is that we connect on a real-time basis to this data. So we ask small business owners to land on our site and give us direct access via API feeds predominantly to data sources and companies that relate to how they run their business on a day-to-day basis. So think of it as your bank account or your accounting packages or the social networks you use to keep in touch with your customers or shipping, your online shipping partner or your payment processor, those types of data sources. And we pull those down. We ask them to give us access to those data sources, not just for the moment that they're qualifying for an account, but we stay connected to that data. And the impact that has over time is remarkable because not only are we have very rich underwriting data, but we also have the ability to offer a product which we call is living and breathing. It's a line of credit which we can elevator up or down based on the risk or the opportunity we see with our small business customers. The other thing that allows us to do is to really, and so when you have a living, breathing product, customer comes back again and again. So our average customer takes about draws cash about 20 times over a 3 to 4 year period, versus our largest competitor, which is about 2.2 times over the same lifetime. And Pascal mentioned a moment ago during his talk how cost of acquisition is really critical to new fintechs and how you need to be able to manage cost of acquisition. Absolutely. One way you manage cost of acquisition is have your customers come back time and time again. The other thing is when you automate in that way, you have the ability to have fewer people involved in the process of providing capital. And so we tend to operate at about half or less on a relative basis of the number of people in our company. And those two pieces, your OpEx and your cost of acquisition, are just as important as your cost of non-performing loans in the business. You need to manage all three of those pieces downward in order to build a profitable business in the small business financing or funding segment.
So that's really interesting. So coming from a bank, I think banks have a challenge in managing credit lines on an on-demand basis, which seems like something you guys have managed to do well. So the banks, friends or foes?
So, you know, it's funny, and I think Pascal brought this up also in his talk, was talking about how the first wave of companies came out very, brash way and talked about how they were going to put the banks out of business. I've always thought that was stupid. If the global financial crisis really proved anything, it was that the banks were going to be around for the long term. Kabbage is not going to receive a bailout from any government or anything like that. So it's incumbent upon us to just be able to make our own way. But we've always taken the position that partnering with the banks makes a lot of sense because banks have several advantages over us. They have a huge existing customer base. They have the lowest cost of capital out there. We're never going to come close to their cost of capital. They've got distribution through networks of branches and others. They've got a lot of goodwill in their brand. They've got a lot of data within their organization. We bring a great operational leverage model to a bank, and we also have an ability to take a look at data that exists outside the organization. We can bring those two items to bear in a relationship, but it requires a couple of things. One is the fintech, in my opinion, talking in a broader sense, needs to stop with his or her arrogance. I think a lot of fintechs have a lot of arrogance around the fact that they don't need the banks. And similarly, the banks need to dispense with their arrogance that fintechs really have not a lot to offer and have not been able to prove their worth over time. I think if both parties can check their egos at the door and get together, you'll see there are a lot of great opportunities to work together. We've partnered with Santander, even though apparently we haven't reached escape velocity. Thanks, Pascal, for not giving us credit on that one. Maybe next time. We partner with ING and Scotiabank. And these are large banks. We're launched outside of the US and Australia, Spain, UK, Canada, Mexico. We're about to launch 2 other European countries in the next 6 weeks. And so we believe in partnership. We believe it can be done. We believe it needs to, though, be a partnership. It can't be a vendor-vendee relationship. That's very, very critical.
So when you partner with the banks, How does it work? You use the bank's balance sheet to lend to the customers, and you provide the operating model to do it. What sort of partnership do you usually do?
So, well, one thing is we've actually walked away from, or banks have walked away from more partnerships than we've entered into to date, because we have a very specific model, which is we need, first of all, we are licensing our technology platform, and it's really around the data that I described a moment ago. Anybody can provide a workflow process to a bank, but not everybody understands how to actually acquire and assimilate data sources and monitor those data sources over time for continued performance of the small business. So we license that. We actually require that our brand be part of the user experience. It doesn't have to be giant and flashing like a Las Vegas sign, but it needs to be out there. And then finally, we actually want to have the opportunity to participate in the book. Usually that comes in the form of, if there's a customer to whom the bank is not comfortable lending, we would like to have a second look opportunity at that customer, but all within an experience that is seamless, not to unnecessarily plug the conference, but is seamless to the customer so that they get an answer. And ultimately, the more times you can say yes to a customer, the better for the bank, and in connection with the goodwill that the bank gets from saying yes to the customer.
And when you look at the ecosystems or the countries you want to move into, how important is the baseline that all data has to be moved into your system? So it has to be real-time available to you as you decide to move to these countries.
It's actually pretty critical. And what we've done in economies that, and I notice there's obviously still a very high cash component to a lot of, to this region, as well as a bunch of other regions where we're operating. We usually say that, look, data is the key, and we want to find a way to automate the intake of data and be able to make automated decisions for the same reasons that I described a moment ago, not just for underwriting, but it's also for maintaining a low cost of acquisition and a low operational expense base. So automation is absolutely, absolutely necessary. And so many times, so we had one of the largest banks in the world come into our offices a couple of years ago, and they said, hey, we love your onboarding process, but in addition to that, would you be willing to do A, B, C, D, E, and F? And they were all manual steps. And Catherine's, who's in the audience again, a quick response was, well, look, we can add as much friction to the process as you'd like, but at some point it doesn't make sense for you to partner with us. And that's the right answer, right? We're not the right partners for a lot of folks out there who don't have comfort around automating these systems and recognizing that these other expense areas are just as important as the expense of non-performing loans or the expense of just, decades of traditional approaches to it.
So, one of the big challenges with lending is every business has a cycle. You mentioned earlier about the banks needed bailing out. They have huge balance sheets. Still, as we can see, sometimes they need some help. What do you do at Kabbage to make sure during the next downturn, you come out stronger relative to your competitors and able to go through that, especially since you don't actually get the liabilities on your book?
Well, I think there's a couple of things. One is, I think there's a lot of things floating around here. One is, for our direct business in the U.S., we do take full balance sheet risk, and we do have a risk of loss in those receivables. For bank partnerships, oftentimes the bank is the one that's taking it. Now, you should understand that we spend a lot of time developing the risk models in partnership with the banks because it's important for us to incorporate those elements that have always been and are critical parts of the way they think about underwriting small business customers. They have to be comfortable or the deal's not going to go forward. So that's part one. Part two is, when we were first looking for capital going out there, we had a lot of people who were saying to us, hey, can you, what are you going to do in the case of a downturn? And there are really two aspects to that. One is credit risk. So, customers not performing, and then the attendant impact to your ability to acquire capital to be able to lend, because we go through securitizations, we go through other processes to acquire the capital that we lend out. And our answer at the time was a couple-fold. With respect to credit risk, it was about the fact that we connect to these customers. There's a couple things. One is, and I didn't really discuss our product structure, but what we do is we provide a line of credit to a customer. The customer can take as little of that line of credit or as much of that line of credit at any point, as long as they have open to borrow. And as they pay that back, it then replenishes their open to borrow. And so this creates a situation where they're obviously just taking the capital they need at that moment in time that they need it. So we're able to elevator that up and down based on the credit risk we see. Our ability to, from an ongoing basis, monitor the data of our customers allows us to manage that. And we do increase and decrease credit lines as we see stress in the business. And so with respect to a credit cycle, at any given time, the small business owners we work with are not the ones buying fancy cars, big homes, second, vacation properties, jetting all over the world. That's just not their lifestyle. They have families, they work, 75 hours a week. They're the hardest working people out there. They're really the backbone of every economy I know of out in the world. And at any point in time, there is a meaningful percentage of them that is going through some level of stress in their lives, because their lives are connected to their businesses. And so our ability to very closely monitor them on a day-to-day basis over the last 6 or 7 years puts us in good position to manage that issue. And somebody had brought it up the other day in a meeting. They said, well, how do you know how do you know your models will be reactive to a credit crunch? We're like, they already are. And if you think about it, what we do today is, if we see stress in the business, and we do see stress in business, we automatically lower our open to borrow right now. We'll just wake up one day and say, uh-oh, we don't have a lot of cash available to our customers, because many more of them are going through stress than we're going through stress today. So it becomes a sizing issue. The only other part I'd point out is the capital markets. And the fact of the matter is, we're not a marketplace. We're not like Prosper or Lending Club or Avant or other companies that go through a situation where they sell their loans to a third party. We actually hold on to the balance sheet risk. So when everybody else was going through trouble last year and not being able to acquire capital lend, we were not going through that issue, because we were paying a fixed rate of return to our investors, and that made a big difference to them.
So, Rob, what's your customer base? Yeah, so SME is fairly broad. Yeah, what side of revenue do you look at to target your customers?
Yeah, so it is. And when we started, we were very e-commerce focused, meaning effectively all of our customers were selling products online over sites like eBay and Amazon. And we did that, I would say, close to 100% of our business through most of 2013. Then we actually expanded to include really all small businesses. We took a giant leap into the all small businesses world, meaning that it was not just e-commerce, but it was your dry cleaners and restaurants and accountants and lawyers and doctors and you name it, from professional to blue collar. We were really serving all customers. And that transition, actually, it was amazing, because you might think, from coming from a banking perspective, that, oh my gosh, you've got to, very, very incrementally increase risk as you go to audiences you're not familiar with. But we actually went from what I would call a much higher risk population. Folks who are e-commerce sellers were part of the new economy. They were much smaller businesses, and in many cases, they were second businesses or second jobs for our customers. In this case, we moved into businesses that were part of just the normal fabric of the small business society. And so the risk actually went dramatically down after we entered into these markets. And in addition, the businesses were much larger than the businesses we were serving. So our average business has been around for about 9 years, does close to $1 million in revenue. We represent every industry out there other than those that are illegal. But we also, very importantly, we proved that you could actually make a funding decision to an eBay seller and make it in a profitable way, make a profitable decision at that level, at a very low and granular level, very small business. was small of the small business spectrum. So as we went up market, we were able to actually enter into larger lines. If you can prove you can provide cash profitably to a very small business, really the sky's the limit at that point.
Okay, fantastic. So Rob, let's switch from Rob, the founder and CEO of Kabbage, to Rob, the entrepreneur. Yeah. Pascal mentioned there's thousands of fintechs out there. Yeah? When you started back in the day, how do you get through the noise? What do you do to make sure people remember Kabbage or start noticing Kabbage? Yeah,
well, as my co-founder will tell you, we like to joke that we were 22 when we started this, but we weren't. We weren't the 20-year-old starting the business, dropping out of college and starting a business. We were older. I was 40 years old, had a family and lots of responsibilities. But I think you have to have the attitude. I think that brings a certain maturity to the world of entrepreneurship, but you still have to have the verve of a young entrepreneur. And so, one of the things we did to get noticed by customers at first, we had no marketing budget. So we would go, eBay had these, what they called on-location events, where they'd have a couple thousand sellers that showed up to different locations around the US. And Catherine Mark and I would literally go there, and we would be wearing our Kabbage garb, and we would be carrying our paraphernalia, and we would be sharing it with everybody there and talking with people about Kabbage and learning the industry ourselves. I'll never forget the first one we went to was March of 2010 or 9. Well, I guess I can't forget because it was one of those years. But great experience. And what was also really interesting is we go up to these small business sellers and we say, we'd like to buy you a drink. And they were like, are you talking to me? And we're like, yeah. And they're like, why are you buying us a drink? And we're like, because we want you as a customer. And they're like, nobody has ever treated us like we mattered. No small business owner ever really cared about us enough to buy us a drink. And we're like, well, that just makes sense to us because you are. So we would do those things. So that's how we got noticed in the sort of to the customer world. So we did that a lot. And it was really just the three of us going out and doing that. The other thing we did sort of on the technology and investment side, one story I can remember is the very first TechCrunch Disrupt, which is TechCrunch's conferences they have, frankly, now globally, but it was their very first one in May of 2010. And I do remember, I'm not sure if I'm proud of this or not, but we were in what was called Startup Alley. We weren't important enough to make the main stage and present, but they had a Startup Alley of about 50 startups that were trying to catch the attention of folks. And I went there it opened at 9. I got there at 6 o'clock in the morning. And I looked at our table position. And our table position, there was this Startup Alley. We were way in the back on the other side, and there's this one spot with this other company that had clearly the best spot. I might have switched the signs between the two. So we were on the front end table, and so everybody could see us when they walked in. We also had these little cards, that talked about Kabbage, and literally littered them everywhere. So we put them on the escalators up and the escalator down, put them on every table. I went into the men's room and put them in the urinal, so you'd see them when people were using the bathroom. And that, I think, is just part of what you do as a startup. It's a lot of it's not glamorous. In fact, most of it is not glamorous. Probably over 100% is not glamorous at all. But those are the things I think you need to do. And by the way, don't know if any of that ever worked, right? You don't know whether specifically anything you do is really the thing that makes the company work. But what you do know is when you look at the sort of the landscape of everything you've done, something apparently worked. And you just have to be willing to do it all in order to see what sticks. And I think that's what we did.
Fantastic. One last question from my side. Having a startup, you have to make a lot of tough decisions. Yeah? What do you think is the one ingredient that you need to make sure you have a robust product and you have a good chance of making it through? Yeah?
Yeah, so I guess, I think the decisions that you I think the path that you set the business out on is important. I think there's sometimes the things you decide not to do are more important than the things you decide to do. I think one really good example is when we were out looking for capital early on, investors said, well, we see that at the point where you ask customers to add data, there's a drop-off. It's not huge, but it's meaningful. 15%, 20% of potential customers walk away when you tell them to give you access to key data sources. Why don't you just give them a manual option so that way you capture 100% of the customers? And that makes sense, right? Why let potential customers go away? Give them a manual, give them electronic. But we, for whatever reason, we just sat there and we said, no. If you want to get a loan from Kabbage, you're going to have to give us access to data. And I have to say that we weren't really sure why we were making that decision, but we realized it was important for some reason. And here we were years later looking at that. And I think as the theory goes, if we had asked 100 small business owners whether they wanted to give us access to data manually or electronically, 80% of them would have said manually, just because that was what they were used to. And 20% would have given us electronic access, being the 100%. But if you tell 100 small business owners the only way you're going to be able to work with us is to give us electronic access, 80% will give you electronic access and 20% will go away. But at the end of the day, you have electronic access to 100% of your customers. And so we do. And because we have that, we then have the ability to really drive down cost of acquisition and cost of OpEx. Everybody else in the space provided a manual option, and electronic was an afterthought. And it has two impacts. It has the impact that I described, which is most customers go manual, but the other impact is what it does to your company on the inside. What it does on the inside is it tells people that electronic access to data is not important, and it ultimately becomes de-emphasized and unimportant. And for us, the reason we were able to get through 2016, which was a very difficult year for a lot of our brethren in the space, and not only get through, but really accelerate, was because of electronic access to data and the positive impacts that had across the business, and the story it allowed us to describe, and the opportunity to partner with large banks globally, because we don't have to land a workforce every time we do that. We're able to connect people in a technologically elegant way. And so so that decision that we didn't make to give a manual option was, I would say, is the reason why Kabbage is in business today. I think if we had made some other decision, we would not be in business today.
Fantastic. I want to open up the floor to questions. I think we've got one right here. I think we've got it.
So far I heard, I like the idea of the strategic advantage.
Which is a great start.
Charmaine Oak here. I like the idea of the strategic advantage you got from probably 2010 from the real-time access to data. But what are your thoughts on the problem cybersecurity faces us, say in the last 3 years, and how do you go to sleep comfortably at night thinking that you have all that data?
So the question around for those who didn't catch the whole thing was, electronic access to data is clearly a great advantage in 2010. What's the concern around some of the cybersecurity threats you have today? And I think and I liken it to the argument that was made years ago about putting your credit card online to pay for e-commerce transactions. And what people would say is, well, in the U.S., you hand your credit card to a server at a restaurant and they take it into a back room and swipe it. I know in most other countries it's a lot more intelligent the way they bring it to the table. But the fact of the matter is the level of threat around gaining access, the key here is there are standards in place to protect data that's accessed via API. Every bit of data that we get is authorized by our customers, and our customers go through an authorization process, either OAuth, auth and auth, or some other mechanism delivered by a third-party data surface to allow secure access and customer permissioned access to data. So none of the data that we get is sort of subverted or circumvented through the customer. The customer is involved in that decision each step of the way. That's number one. Number two, the data access we get is read-only. So we have no ability to write at all to the data source that we're accessing. So no concern there. Number three, we hold no credentials. of our customers. This, again, through an auth and auth process, the credentials are retained by the third party who actually provides us with an electronic token that allows us to get read-only access to the data. So all of those issues, and the fact of the matter, the bigger issue for customers from a data access perspective is not understanding what their data is. I mean, the fact of the matter is there are a lot of third parties right now, banks and others, that would like to prevent companies like Kabbage from gaining access to data to provide services to their customers because they see that as threatened. But the fact of the matter is most of the fraud that occurs, for example, within the bank accounts goes undetected by a customer simply because they're not paying attention to the data in their account. So actually giving a third party that's actually able to see variations in that data and take action on that, on the account to the user or the authorized provider of that permission is actually pretty important and actually decreases the level of risk associated with fraud. But it's a good question, and it's clearly, obviously, a question I've had before. Thank you.
I think we are out of time, but Rob's going to be available for some more questions. Rob, I want to thank you for joining us. Thank you very much. Thanks.